The International Monetary Fund is yet to see evidence on the benefits of Kenya's massive investments in infrastructure, even as more billions of shillings are pumped in that direction. To tame the rising debt and strengthen the fiscal consolidation agenda, the IMF says that Kenya will have to raise its tax revenue to GDP ratio by at least half a percentage point every year. The fund says there is need to create sufficient fiscal space to give the economy muscle to address emerging shocks. As Kenya grapples with the headache of ambitious spending plans and below-target revenue mobilization, the International Monetary Fund now prescribes the country should grow its tax revenue to GDP ratio by at least half a percentage point over the next 5 years to mitigate rising fiscal pressures. If this is anything to go by, Kenya should have grown its total tax revenue by 172 billion shillings in the financial year 2018-2019, compared to the actual 98.6 billion shillings growth registered.
Tax to GDP revenues in the region tend to be below potential in most countries. There's a lot of scope to tap that and mobilize more revenues. And the important thing about mobilizing more revenues is that you can create more spending space to address the still ongoing development needs, of course.
The IMF also says the recent move by members of parliament to revise the country's debt ceiling from 50% of GDP to 9 trillion shillings should not deteriorate the country's risk perception, as long as the public finance management framework is kept sound.
Nominal debt target ceilings are not uncommon. The key thing really with fiscal policy in Kenya is we've seen debt levels go up, but by and large reflecting all of the investment that the government has been undertaking in infrastructure. But what hasn't been done enough is to capture the rate of return on all this infrastructure investment.
The IMF is also confident that despite tightening global conditions and rising debt concerns, Kenya should be able to access the international capital markets at a favorable interest rate if it seeks to meet part of the 608 billion shillings fiscal deficit through commercial debt.
There remains quite a lot of risk appetite for, I think, Kenya. It depends on market conditions at the conjuncture, indeed global conditions. I don't have no doubt Kenya will be able to access financial markets, when it wants to, and because the policy management remains strong.
On the monetary policy front, the International Monetary Fund has lauded the manner in which the central bank steered the demonetization exercise, which was concluded at the end of September.
The demonetization, by all accounts, seems to have proceeded quite well. Logistically, it seemed, to have been implemented as well as it can be expected, and kudos to the efficient and effective implementation of it.
The central bank oversaw the withdrawal of 217 million pieces of the old generation 1,000 shillings note from circulation, replacing it with a new generation note. The regulator is, however, yet to give a concrete timeframe on when it shall replace lower denomination notes.